Appreciate you coming to episode 11 of the J&J Show. I'm Josh Yoskosky.
I'm Joe Simon.
And we have another guest this week. So as you probably know in our prior podcast, we talk very macro, very large level, high level economics and expectations in the market. That is the strategic side of things. This week, we're going to talk tactical. We're going to talk specific areas of the portfolio. With greater specificity, we're going to talk about the small companies in the U.S., small cap companies.
I'm excited to introduce Michael Mack. He is the client portfolio manager for VictoryShares. He manages a couple other ETFs. And with that, I'm going to turn it over to Mike and kind of give us a big picture intro to what you do over at VictoryShares and kind of some of your thoughts from a macro standpoint on small cap funds.
Great. Thanks for having me. Yeah, it's an interesting backdrop. We know that, over time you get rewarded for being in the equity market. Oftentimes everyone has fear, but really being a long-term patient investment matters, right? And what do you want to do when you're investing in the market? You want to focus on quality. But we think ultimately optimism is rewarded in the equity market. That being said, while the markets have done well the past decade, there are a couple challenges the market faces today. Number one, market concentration. The Mag 7 make up over 35% of the S&P.
Yep.
They're even falling into these places you would never expect. We've seen 3 of the Mag 7 are now in the value index. There is NVIDIA has made its way into a couple high dividend ETFs. Yeah.
I would have never even guessed that.
Yeah, that would not have been
amazing.
my expectation.
No.
Yeah.
The worst one, the craziest one is NVIDIA. I'm sorry, not NVIDIA. Tesla is in a value index now. So that was, if you would have said Tesla and a value index in the same sentence, I would have never
I don't know if
believed
I would
you.
have guessed it now even.
I wouldn't have believed you.
Yeah.
I want to fact check myself
Yep.
every time I say it.
Yeah.
Well, excellent. Well, I kind of, obviously we just added the small cap free flow ETF into the portfolio. Can you talk a little bit about, I think let's start big picture, small caps in general, how you see them. They've been underperforming for years. We started to see a pickup in performance last year. What's kind of your thoughts around, what the next, maybe 12, 24, 36 months look like for small cap? And then maybe delve down from there into, do we like value? Do we like growth in that? And kind of just some of the more specific details.
And why, to your point, talking about free cash flow. And a lot of people know the metrics on how much of the Russell 2000 is actually profitable.
Yeah.
So it's a big discussion point. It's a portion of the portfolio we've always had.
Yeah.
But a lot of people go back to, well, I purchased this position in 2021 and I'm finally getting back to that break even. Or, we typically undertake small cap for greater rewards than large cap, but that hasn't necessarily held true. So love to hear your thoughts about why small cap, why now, why value, what versus growth.
And even kind of that thought process of value in a small cap. Aren't those small companies? Aren't they supposed to be growing?
Yep.
Maybe some thoughts around that as well.
Yeah, it's a great talking point. I mean, if we look back, the late 90s was the last time we saw this big of a run for large cap versus small cap. And, at that time, everyone was, starting to question, do I need small caps? And then what happens? Small caps have a phenomenal decade following the 90s. And then everyone was, fama French, the academic research, they found there's 3 drivers of return, value, your market beta, and size.
Yep.
And it's funny today as we get there, we see people saying, is size even a factor anymore? Or my favorite one is companies are IPOing later. So why do we need small cap?
Yep.
With the pre-IPO stuff. What's interesting about small cap is, number one, from a valuation standpoint, it's attractive. We're seeing some of the most attractive valuations we've seen in 25 years. The other thing is that it does require patience, as you guys alluded to at the beginning. In large cap, when there's a mispricing, it tends to correct itself fast. In that marketplace, you have a lot of eyeballs on these companies.
Yeah.
So when dislocations happen, in small cap, things can stay out of favor for periods of time. They can stay undervalued. It's a less efficient market. And so in our opinion, what that means is patience is required. It's almost like a stair step up. Oftentimes with small cap strategies, we'll see it can be 2-3 years. Why do I own this? And then off to the races, which we kind of saw last year in international.
Yeah.
If we
So
were sitting here, people would be like, why do we have...
And that was a lot of the discussion the past few years of, well, what are we doing with this? I've had it for 3 years. What's going on? Well, then we see this past year.
But also you talked about less efficient, right, and patience, right? But sometimes, if it's less efficient and you do have patience, there's more opportunity for growth, right? bigger returns.
That's it. And that's we like to focus on, we talk a lot about ETFs,
Yep.
rules-based applications. Well, the reason we like rules-based strategies is we think there's the ability to be patient, right? Where there are names where, the market, if you look at the traders in the market, all the investors in the marketplace today, the time horizon keeps getting shorter and shorter and shorter. And so we think that creates opportunities for those who are willing to be patient. And an index is the perfect application of that, where you're looking through the long term. And in this case, you talked about the small cap free cash flow. That's going to look at a company's free cash flow as a guide to how attractive they are. And when prices go in the opposite direction, but the cash flow continues to do well, we think that creates opportunity.
And then for our clients that are watching us that aren't as sophisticated, with the market, can you talk a little bit about what free cash flow is, what that means? And
I think
and
another side is the rules-based side of how some investments are managed and some are not. So I think it's another area worth touching on.
Yeah. So tackle both of those. Number one with small cap, it's a measure of profitability.
Okay.
It tells you how well the company's doing. The ultimate goal is for companies to bring in more cash than they spend. Everyone knows it, in the personal level, the person who's, the millionaire next door versus the neighbor that's keeping up with the Joneses with 4 cars. The same thing applies to companies. There's companies that spend beyond their means. And so companies that are able to generate free cash flow, we think are healthy companies.
Okay.
The other nice thing about companies having free cash flow is they have abilities to hand that back to shareholders via dividends, but also via buybacks, where the company buys back stock. And for an investor, what that means is when they're buying back stock, they're reducing shares. So it's almost like being in a partnership where your partner buys all the other partners out for you.
I think a lot of our clients would have seen that in a company like Apple, right?
Yes. Apple's a crazy example. At one point, Apple had reduced their shares outstanding 50%.
Wow.
So you basically end up, right, because the market, if you look at the market cap versus the shares, it's the price. So the less shares, the higher
Multiple
price.
of. Yeah.
Yeah.
Now, as far as the rules-based investing, what kind of for our clients out there, could you kind of delve into that a little bit? And
Yeah. Rules-based, the nice thing is not responding to emotion. You're going to get times where fundamentals and sentiment deviate. We're in a world where narratives drive stocks more than ever. And so often narratives can be wrong. I remember, I'm sure you guys do too. Remember last year when Google's search business was going to be killed by AI?
Yep.
Oh, yeah.
Yep.
And here we sit back now. So it's important, we think, to look through sentiment and focus on fundamentals. One of the challenges someone gave me a long time ago was go read Warren Buffett's letters, like the last 30 years. It's all available on a website. And one of the things that always stuck out to me about his approach is he never let prices affect. When he talked about his portfolio, he looked through. So when he owned, he would own companies like Disney, Coca-Cola. He didn't look at the short-term stock price performance. He looked at the underlying business performance. And so when we think of these indexes, we think that's the goal of, we want to anchor to something that matters. In this case, we think it's free cash flow. And so prices are going to go up and down. What you just want to make sure is that you're allocating to companies that are generating free cash flow. So when the price goes down, you ultimately think it's going to converge towards the cash flows.
And I think that's smart to think about it from that standpoint, because obviously when you're looking at smaller companies, right, there's more risk, right?
That's right.
And taking that free cash flow approach, I think, would mitigate a lot of the risk that you would take with these companies. Am I looking at that correctly or thinking about that correctly?
That's very true. In small cap, we see there's a ton of opportunities, right? You have, depending on how you define it, 2,000, 2,500 names to choose from. But there are a lot of landmines out there. You take the broad-based benchmark, the Russell 2000, 40% of those companies are unprofitable.
And I would think that, again, that's where having some sort of active management in a market cap like that can make a big difference, as opposed to a larger cap or an S&P type 500 approach.
Absolutely, yeah. The way we tag it is active rules based. So I'll give my compliance due. One of the things is I'll say we believe. That always refers to the views of the VictoryShares and Solutions team as a part of Victory Capital. But having the rules-based applications can be very beneficial.
Yeah. Great. So
one thing that I see come up, or another space that we often talk about or asked about in conjunction with small cap, is then we get into the world of mid.
Yeah.
And mid cap's a lot harder to talk about, in my opinion. So when we talk about small, mid often comes up, as I alluded to. But what are your thoughts around? Some people say, well, a small company, if it does well, is going to transition to a mid, and then a mid is going to transition to a large. We know that's not often the case.
Yeah.
But those are the sort of questions that come up.
Yeah.
And we look at some mid cap positions, just even worse performance than small cap over the past few years.
Yeah, and honestly, the small cap free actually replaced our mid cap fund.
Oh, yeah.
Yeah.
Okay. Yeah, it used to be the sweet spot, right?
Yep.
The S curve, enough resources to grow, but still enough space to not be in too large of a company.
Yeah.
But yeah, graduates are definitely a part of it. The attractiveness of a small cap universe. The other thing that's interesting sometimes people are like, well, why own small companies? Because if they were good, wouldn't they be large companies?
Yep.
There are actually some really boring but interesting. Oh, that's an oxymoron, right?
Yeah.
But they're attractive investments in our opinion because, like, one example is Allison Transmissions. They, one of the
Josh
top,
is a car guy.
Oh, are you?
GM
Okay.
Duramax.
You just warmed
That's
his
right.
heart up right there.
Yeah,
I think they just had a deal. They're going to
That's
keep
right.
working together.
Loves
They
it.
weren't going to.
Good, then you can help me out with this one. As I understand it, they make transmissions. Like school buses, I think, is one common application.
Behind GM diesels typically is where they make a bulletproof transmission, as it were.
Okay, and they can charge higher prices, right? Because
You
their
do pay
quality,
a
they've been
premium
known
for
to
that.
last
Yep.
longer.
Yep.
So from a business standpoint, what we see is they have higher margins. They're able to charge higher prices because of the quality of their product. Now, what's interesting is transmissions, that's not the biggest market in the world. But they are a clear, one of the clear leaders in that space. What's interesting about how they operate is they use that free cash flow they generate. And we talked earlier about buybacks. They're returning all the cash flow back to shareholders. Now, what's nice about that is they're not getting bigger as a company. We talked about reducing your shares.
Yep.
They're happy to stay profitable, hand the cash back to shareholders, and stay small. It allows them to stay in where they can stay in their lane where they have expertise. Versus if they tried to branch out and become a larger company, compete with Ford and GM, it would probably be harder to maintain the profitability of the business.
No, and I can appreciate that, specifically that example of their small cap and want to stay in that space. It's not the idea of you go small, medium, large because you're successful. If you know your niche, you may stay in that small area, which is probably not the discussion that comes up most of the time.
I mean, it's probably too. I mean, from a quality standpoint too, right? They're probably a company that wants to have good financials but have a quality product. And I think sometimes when you get too large, you start to lose quality overall as well.
Yeah, jack of all, master of
Yep.
none. They have a specific area. And I don't know if that's perhaps the case for a lot of the small cap companies when looking at free cash flow, that is the story with them.
Yeah, it's interesting too in that regards. You guys mentioned kind of like growing your business and why maybe it's not the ideal way. There's been a lot of research on asset growth or high capex. In that companies, you want to think that companies that are spending and investing, that's always going to be a good thing. Oftentimes, though, when companies are growing their assets significantly and overexpanding, so to speak, that's actually been a challenge, right? And I think if you look at the Mag 7 today, some of the worries there, they are trying to grow so rapidly. They're spending so much money, actually really across all the AI space. They're spending so much and people are starting to question, are these investments ultimately going to pay out? And then as you grow, and the other thing is if everyone in your sector is growing, that's a red flag because it means your competition is through the roof.
Absolutely.
Well, and that's a conversation we had in our previous podcast as far as AI. All the investment in there is kind of getting over its skis, right? So where are the profits going to come from and when are they going to come, right?
Yep.
And, they don't have the answers to that yet. And that may, that may lead to, some sort of correction in the AI market soon.
Well, I think we've seen a lot of it, of nervousness about, okay, is it out over its skis? Has it grown this much for a reason? Well, that's an unknown, and it sounds like, not to put words in your mouth, it's more understandable why a small cap company may be growing. It's going to be something that, to your point, in the financials, small versus large, because there aren't as many analysts or there aren't as many eyes on it, small is going to perhaps have those opportunities that mispricing is going to be found in the large space immediately.
Yeah, when we look at we have a small cap free cash flow index, we have a large cap. It's interesting from a characteristics. We look a lot at portfolio statistics, attributes of a company. What's their free cash flow yield? How much cash flow are they generating relative to the price? The more being better, or even the growth rates of the company. When you look at a small cap index, it's actually going to have higher growth rates, higher free cash flow yield because you have that wider opportunity set, starting from a 2,500 stock universe.
Yeah. Let's pull it back out 40,000 feet. And if you can give us kind of your outlook for small caps going forward, obviously there's a lot going on in the world, right?
Yeah.
Inflation's a big factor here, right? So let's kind of talk about that from a bigger picture standpoint.
Yeah, you certainly, when you look at inflation, that's interesting for small cap in a couple regards. But one of the things we want to do to help combat inflation is companies with strong balance sheets. Because one of the things we see in small cap is a lot of companies, they're not big enough to issue bonds.
Yeah.
They have to go to banks for financing, and a lot of that debt tends to be variable. So when you look at the broad small cap universe, you're going to have more leverage. You're going to have floating rates, which can be a challenge when in an inflationary environment.
Certainly.
That can create challenges.
And that's why I mentioned it, right? 'Cause
Yeah.
rates coming down, or if they do come down, should benefit small companies.
Absolutely. Rates coming down. And the other thing we're hearing a lot of is, the economic stimulus is really starting to kick in this year.
Yep.
The tax benefits for CapEx and R&D and reinvesting in your business. Small cap, one of the things about small cap is it is definitely more sensitive to economic growth. So,
Well, they're more nimble as well, right? So
That's
they
right.
can make changes to take advantage of that growth a little bit quicker, which is typically why small caps lead the way out of a correction or a down market, right?
that's absolutely the case. Yep. It should be. I should say. Absolutely.
Yeah.
I can't say that word.
Now,
By
do you kinda-
right.
Yeah.
From a big picture, do you kind of see us at that point now, or that inflection where we think that the time is coming for small caps here?
It feels like it. It feels similar to international last year. Just this idea of something hasn't worked for a while. It's and there's everyone's getting impatient. And even though, again, you look at the valuations, the most compelling, you get the economic tailwinds. You have a lot of things working in small cap favors from a forward-looking perspective.
And Josh is one of his favorite things to say is the numbers tell the story. So I'm
They do.
assuming that's what you're trying to tell us here. Is that actually the numbers are telling us the story for that small cap turnaround?
That's true. Yeah, I would agree with that.
So pivoting a little bit, but growth is what most people are talking about. So
Yeah.
we've been talking about cash flow. We've been talking about the value side. In any space, why value as opposed to growth? Knowing that growth may be what people are talking about, that doesn't necessarily mean that's where the long-term, no pun intended, value is. But value versus growth is always an age-old discussion as well. Why in the small space, that some people may say, well, is there a small AI company that's going to be purchased by NVIDIA? Or why the value spot and how that fits in a portfolio?
Josh, that's because growth is sexy. Value is not,
It's
right?
true. It's true.
That's true.
It's on people's lips.
Yeah.
Very much so. And it's interesting. You talk about large and small cap. You talk about value and growth. There's actually a correlation. Small and value tend to go hand in hand, where
Yeah.
large and growth tend to go hand in hand. Even a couple of years ago, the S&P 500 was actually falling on the growth side of the style box. A lot of providers have since tweaked their methodologies to kind of bring balance back. But you've certainly seen a broad overlap between growth and large cap. And so that's done well, but valuations have got stretched. And so if you look at the S&P 500 today, we're at 22 times earnings. And the risk of that is historically at those levels, volatility is tended to ensue. And the fear is 2022, where you start the year at 22 times earnings, you end at 16. It's the price of your portfolio going down. If you look at the quality segments of small cap today, you're able to find companies that are trading at 12 or 10, 12, 11 times earnings, which is pretty attractive relative to the overall market. So I'll steal a line from my old boss. Lower your PE before the market does it for you.
I like it. Yeah.
Control what you can control
Yep.
from a valuation standpoint.
And going to the S&P valuation, it's something Josh and I have been talking about. And again, if this is outside of kind of your realm, can you talk a little bit about, not only small caps, but how international fits in with that as well? Do you guys look or have any international within your portfolios?
We do have a couple internationally focused ETFs that really look at free cash flow.
Yeah.
And when we look at free cash flow, the indexes we have two applications. We have free cash flow yield, which is really how much am I getting for what I'm paying? Kind of if you think of a real estate example, which always helps people understand it, it's how much rental income am I getting versus the cost of purchasing on the home. On the growth side, what we look at from a free cash flow lens is free cash flow to invested capital. So ignoring the market price of that company or that investment and just looking at how much you're getting versus the cost of investing. So if you're a growth investor, you say, if I put $1 into a business, how much am I getting back in free cash flow? That's what it's trying to tell you. So we have two applications there. It's interesting on the international side, though. There's always the concern about quality, and it's always going to be hard to match the U.S. technology sector. But when you focus on the quality sides of international, we do see some interesting opportunities emerge. And what's interesting to note about international is there are dislocations where once you match quality, so you do like for like in terms of the quality of a business, depending on how you measure it. A lot of people look at like profitability factors as a way. But once you're focused on the quality subset and you compare apples to apples, what you find in international is oftentimes you have a chance to get a company at a more attractive valuation. So maybe 25 times earnings on the growth side versus what you'd pay 35 to 40 in the US. So that's what we think of international as an opportunity. When you focus on quality there, there's opportunities to get companies at more attractive valuations.
Awesome. Now, we talked about AI a little bit. I want to kind of go back there and, when it comes to small companies, is there an AI play there? Is there some opportunity within the AI field? And if so, kind of what does that look like?
Is it the same headwinds across the board?
There wasn't originally a direct play, but now what I think we're going from the phase of, the first beneficiaries of AI were semiconductors. And the thought is now it's starting to broaden out. We first saw it too. It's funny. You could look at an NVIDIA. You've heard of the GPU clusters?
Yes.
My favorite story in the market is there was an example of a company that made the copper wires that connected the GPUs. Well, one day Jensen did a presentation and they switched the color. And the company that provided it, its stock sold off pretty hard. And they had to come out and issue a statement. The cord's green, it's not yellow, it's still our cord. And it was an interesting example of how this market's operating. But we've now broadened out now, and we're starting to see the AI trade really show up. One area is industrials, and that's really specific to small cap, where if you look at most small cap portfolios, you're going to have more industrials. That's one of the sectors that gets overrepresented, or a larger representation in small than it does large. And so those are companies that are benefiting from the broader AI build out. You're seeing demand for electricity show up, and you're seeing companies overall are able to employ AI to become more productive. And you think of small cap companies, what's their largest cost? Oftentimes labor. So if they can use AI as a way to enhance productivity, that's another way small cap companies.
And I like how you put that, because that's the conversation we had about AI, and that's what I hear. I just heard from a client the other day. The economy is going to crash because the AI is going to replace us all. Nobody's going to have a job, and no one's going to be able to spend money, and companies aren't going to earn anything. But the conversation we had with this economist recently was, again, he didn't see it this way. He sees it as what AI is going to be similar to what the internet did for us. It's just going to make our workers more efficient, which could benefit small companies more than anybody else, I'd imagine.
Yeah, that makes a ton of sense. The AI build out, it's really, it's going to, if you believe it. The other thing is a lot of people, for a while, the last 2 months, everyone was thinking AI, it was great, and then it became a destroyer. Like every day, Anthropic would issue a new, and it was like, who's getting hit today? And I think the market started to figure out that at some point, like either AI is going to wipe us all out, or it's going to create opportunities. And so it seems like the market's calmed back down. But it is, right? These cycles always happen. To your point, broadband and the internet was supposed to fundamentally change the world. And at the end of the day, human behavior doesn't change, though. That is a timeless element.
Talking about AI and talking about manufacturing. So what are the other spaces or industries? I think I'm from Western Pennsylvania originally, so there's a lot of energy companies there that are on the smaller side. Is that another area with, and I'll use the phrase drill, baby, drill. I don't know if we've necessarily seen the upswing or the positive growth based around that, but knowing that there are a lot of small energy companies, how does that fit into a thought process?
It's a great question. You think of energy. One of the things of 10 years ago, was the wildcatter era, right? Drill, baby, drill. We used to say growth at any cost. Today, it's profitability at any price. It's interesting to note that a lot of boards changed management compensation to things like free cash flow. It used to be the amount of oil you produced was what your compensation targets were. So it's interesting to see the last couple of years. We've seen a total wholesale shift in the way that sector operates, especially on like the oil and gas producer side, where today it's all about how do we get more from existing rigs. So they're trying to produce more oil per rig. And what's happening is a lot of companies in the U.S. have been able to lower their break-even cost on oil. It used to be in the 70s. Depending on what companies, there are certainly companies here in the U.S. that are starting to get their break-evens in the 40s and some even in the high 30s, which means they've been able to hold up even in a lower oil price environment. Now, recently we've seen the geopolitical tailwind, which, in our opinion, is a good reminder that for the sentiment 6 months ago was oil prices can only go down, and it's like, oh wait, actually in any market prices can go up too. But tying it into AI, it's interesting. It's all interconnected. Oil, natural gas. We know that AI is going to require a ton of electricity. And that's going to be, we're not ready with wind and solar. We don't have you're going to need natural gas to bridge for at least the next 10 years. What's interesting though is what happens in natural gas still spills over into oil. And we saw this in the past, right? People switch. They'll switch from coal to gas to oil. They'll find ways based on prices. And so when prices in one area get really cheap, it creates incentives to use it. So in the case of oil, we were hearing stories of technology companies. One of the challenges is they're spending somewhere in Northern Virginia, right? I don't need to tell anyone here. They're spending, there's such a tax on the grid. Well, a lot of companies are going off grid to produce. Or they're even signing 3 Mile Island came back. Right? And they paid, I think, somewhere around twice the market rate for that. And so we're seeing that, but then also there's been times where they've been using diesel generators. So going back to oil's now finding its way indirectly into AI.
Yeah, it's going to be
through that electricity.
Interesting with all that, and it's kind of you're seeing people or just fighting back. But for example, like my county's looking at putting a data center in, a massive one, and all the residents are up in arms because everybody's like, our electricity is going to go through the roof, right? Our energy costs are going to go through the roof. So I think you're going to start seeing a lot of that around the country as well with these big data centers as they go.
To your point, particularly up here in energy and rumors of, okay, somebody's just going to make their own plant. We'll just produce our own power. We'll go off grid, to your point. So I guess in some respect, bringing that all together, it's anything can be an ancillary service to something else at this point. They can be tied in some secondary or tertiary way.
And one thing I don't want to be remiss in talking about. Obviously, there's some major events going on in the world right now, right? With Iran, and could you spend a little time talking about how all that may affect your space, small companies, if at all?
Well, what there is you look at small cap, there are a sizable amount of energy companies that have made up the small cap index, and we see across the board all of the cyclical sectors within small cap get represented. And so having this right now, the benefit of higher oil prices for the overall energy market. The other thing is you see it's almost a reminder too, right? The reminder that prices can go up. And so you really, within small cap right now, with that, you have higher energy exposure in small cap. So that's probably the primary way you're seeing.
It's funny because that's one of the things we were talking about as we were looking at the fund is the energy exposure. And, because of the exposure you have, do we back off our other exposure within our portfolio because we got a lot of that covered within your fund as well?
Yeah, we like that story.
Yeah. Perfect. What else do you got, Josh?
No, I mean, it's really kind of the sector areas we talk about value versus growth, understanding of free cash flow, why it potentially matters. Everyone knows the large story at this point, but there are definitively other areas of the market that have not appreciated the same way as small cap, or as large cap. And maybe there is a rotation to come there. Maybe there is some nervousness. Is it a case of buying the cheaper asset? It's hard to say, but that goes back to why having diversified portfolio does make sense.
Yeah, and I mean, I do like, the better value you're getting there. And again, with small caps as a whole, I don't know about you, Josh, but I do like taking that more conservative value approach, right? Just because of the risk, right? So I think that's a better approach. I love what you're doing with the free cash flow. I guess I would leave it with, again, we've added this to portfolio. If you want to just put out a couple of final thoughts on why we're going to love the small cap free cash flow fund.
Yeah, it really centers with, you have a rules-based approach. You have inside an ETF, the ETF structure has benefits, intraday trading, most importantly, tax efficiency, the ability to make moves, because you're going to get names that do really well, that no longer are attractively valued.
Yep.
The ETF structure allows the index to rebalance. And so when you get names that do really well, you can change those out for companies that are trading at attractive valuations. So there's a buy low, sell high unemotionally approach to this strategy that's just looking at cash flow and price. And when they deviate, that creates opportunities. But really in small cap, it's about, staying up in quality, like you alluded to, with 40% unprofitable is important, strong balance sheets, healthy companies, attractive valuations, positioned for a turning point should that come in small cap.
Great. I love it all. Mike, I want to thank you for joining us. We really appreciate you taking the time out to come out here and spend about an hour with us.
Yeah, thank you. I really enjoyed it. Great to be here.
With that wraps up episode 11 of the J&J Show.
Yep.
I'm Joe.
I'm Josh.
Like,
Comment,
and subscribe. We'll see you next time.